I'm Keith McCullough, and welcome to another Hedgeye Investing Summit. This is one of my favorite events of the year because I get to selfishly just sit here and listen to people teach me things and really engage on subject matter that matters the most. It's got to be timely and topical. We're trying to find people that can actually save and then hopefully help you make money in that order, by the way. Because again, these are the most important times when you're either having big drawdowns because you're not proactively prepared, or you are indeed hedged or thinking about risk management proactively so that you can, again, save that money you work your whole life to earn. It takes a while, right, Mike Green? And thank you for joining us as our leadoff hitter. It takes a while to make a little pile or a big pile, so we should protect it.
That's the objective, is to both set aside the money and invest in your future and your safety, and at the same time, when you get there, it is to appropriately protect those funds as well.
It's good to see you, man. And at first, but unrelated to investing, but a really cool life event for you. If you don't mind, we're going to show a picture of your son who committed. This is a great picture of. That almost looks like a younger Mike Green with the flow and everything like that.
Yeah, he's got the flow, slightly more of it, but yes, occasionally I find a hair in the middle of my forehead that suggests where it used to end.
That's awesome. Congrats to your son going to Navy. It's a great
Thank
time,
you.
I'm sure, of his life. And you're gonna be. I don't know if are you an empty nester yet or no?
This is our last one, yeah. So in literally at the end of June, when he heads off for plebe summer, we will be empty nesters for the first time. And my wife and I are excited about it, and at the same time trying to figure out where do we want to go next. So,
well, what's going to happen is that you're going to be tweeting more. That's what Liz Ann Saunders says. So she says she's like,
That might be difficult, but yeah, there will be more free time for some things. Hopefully not Twitter, but anyway.
It's good. Well, let's just get into it. Let's maybe start with both your views of the economic cycle and the credit cycle. There are plenty of things to be concerned with this morning. We were talking about the lack of liquidity in the ABS market, for example, on the call. So this is your domain, so I'll let you paint the brush.
Well, so I would separate it into actually three components, right? So there's the economic cycle, there's the dynamics of the credit cycle, and then there's also what I would broadly describe as, the market cycle, right? And so one of the things that I keep trying to focus people on is a huge component of the behavior that we see in U.S. equity markets is quite different than what we're seeing in the rest of the world. The U.S. markets are broadly levitating, whereas if I look at Japan in dollar terms, or I look at Europe in dollar terms, they've sold off pretty significantly already. Part of what is happening is in the U.S. is something you've heard me talk about over and over again, is the dynamics of money flowing into 401ks through passive vehicles like target date funds, et cetera, where as long as people are employed, that money is going to continue to come in. There isn't a discretionary amount associated with it. And so we've seen, I would argue, a divergence where the US markets appear to be levitating. This is not totally dissimilar to the behavior we saw in 2018 or the behavior that we saw to a much less extreme extent. I don't want to draw a direct comparison in the kind of January, February 2020 time period where many people were aware there was something wrong, and yet US equity markets resisted going down. That feels very similar to where we are today. Now, if I look at the economic cycle, it's fairly clear that we are slowing. The question is, to what degree are we slowing, and how aggressively are we slowing, both in reaction to the Fed's hikes and in reaction to the general tightening of economic conditions and financial conditions that are created by things like higher prices and inflation. I'm not sure if I just lost you guys.
No, you're good.
Okay. All right. My screen just did something weird. And that's what I think I would really try to draw attention to, is that we're really seeing a deterioration. Things like the ISM's new orders indices are leading lower. We've seen freight, both a combination of trucking dynamics and, to a lesser extent, broader freight, begin to slow as inventories have built up significantly. Our mutual friend Danielle DiMartino Booth highlighted that inventories are now extraordinarily elevated. That's going to create conditions under which there's a significant slowdown in terms of capital goods ordering, et cetera. So it feels like the cycle is slowing dramatically. And one of the things that concerns me more than anything else is I'm increasingly getting the sense that what we effectively had was a cycle that was in play from 2018 to 2019, where the yield curve had inverted. We were anticipating a recession. We received that in a very abrupt way with the coronavirus dynamics that effectively shut the world down, and then the stimulus launched everything back up. And now it just looks like we're rolling over into an extension of that 2018, 2019 framework, where it does feel like there's a significant profit recession ahead of us.
Yeah, the guys, if you go to slide 42, I think, well, this is an abrupt one. I mean, just to use that yield curve, and I'm using 10-year minus 2-year, 1-year forward. Mike, I don't know if you can see that chart or not, but I'm sure it's emblazoned in your head. What's more typical is you get this smooth, again, it's I guess it's not linear, but there's a smooth nature to the sine curve where an economy peaks and starts to slow and the Fed tightens as they were in the fourth quarter of 2018. And then the yield curve stops doing that because the Fed doesn't like idiotically start raising interest rates. In this case, expected to happen 8 or 9 times this year. So that's why the black line, of course, now is piking. So that, to me, like you're going to have a cycle. I mean, we're in the middle of one that's slowing. To what degree it's slowing, I'm going to spend the whole, ostensibly the whole investing summit, back and forth on that. But I've seen people go as far as to say that it's different this time. Like that picture doesn't matter. It's one thing to say it doesn't matter. To me, it always matters when something as long-standing as a relationship like that does something it's never done. Again, that black line is going down at a faster pace than it ever has before to a lower level than it's ever been.
Yeah, I would actually highlight exactly that. If you pull the chart back up and you almost just take a ruler and extend off of that 2018, 2019, you discover, guess what? It takes you to almost exactly where we are today, right?
Yeah.
That's what I meant by we interrupted the cycle. The Fed began cutting in the fourth quarter of 2018, or their last hike was the fourth quarter of 2018. They had already been cutting coming into the 2020 environment. That steepening of the yield curve typically presages the actual onset of a recession. The yield curve inversion precedes it. And then we just had an impossibly short recession because we were hit so aggressively with stimulus in the immediate aftermath of the coronavirus pandemic and the shutdowns associated with it. There's a very real risk. I mean, what it looks like to me is that we're just returning to that mode. And you mentioned this idea of the Fed being somewhat thoughtful about the response function, with inflation roughly trailing at about 7%. Or the rise in prices, and I always just want to distinguish between those two. You've seen a dramatic rise in relative prices. That is, of course, tying the hands of the Fed. They feel obligated to respond to it. And I would just broadly highlight that we're looking at a situation that is not dissimilar to the late 1970s, where the information that the Fed is receiving could be very flawed in their underlying construction of it, right? They turn and look at the rates market and say, well, what is the market signals sending us? The fact that yields are rising rapidly, particularly in the forwards at the shorter end, they seem to be interpreting this as they are behind the curve on inflation. If anything, the flattening of the curve is telling them the exact opposite, that they are about to respond too aggressively. But we've got the papers both coming from the buy side and from the Fed itself, suggesting that the yield curve inversion doesn't matter this time. And that's always the most frightening thing, right? When the policymakers basically say, yeah, we understand what it says, but it doesn't really mean anything, right? So we're just going to ignore it. Subprime is contained, right?
Yeah. The same people that told us at this time last year that inflation's transitory are telling us that they're going to be freedom fighters on inflation because they know exactly how it's going to go down. And by the way, their growth forecasts are unbelievably too bullish, at least according to us. So that's, they have that in as much wrong as what the market's saying the further out you look on many metrics from bond market signaling perspectives. You had a great tweet on this, though, on the freedom fighting part before. What I love about people who get the game are the one-off quick responses on Twitter, one-liners, because people have their talking points, they have their narratives. Guys, find the tweet where Green basically chirped this guy on April the 8th, this guy Phil Back, who was he said, what kind of people prioritize their stocks at the expense of the hungry? Like, this is an interesting, you quickly, answered that one. I mean, I wonder, how much of political pressure, take it from both sides, if you will. People will say that on Twitter all the time, and I hear it from institutional investors all the time. This time it's different because the Fed really needs to do this for the people.
Yeah, I fail to understand how slitting people's throats is helping them, but the idea, it's really important for people to remember that inflation tells us what happened, right? That is a statement of how prices behaved over the last year. If we attempt to use any form of forward-looking metric, and I understand all the critics will jump in and say CPI doesn't mean anything. Of course, now they're saying, look at the high CPI or the high PCE numbers. But when we look at forward expectations that are embedded in the market, they're not suggesting anything like what we're currently experiencing, right? So the forward 5-year inflation break-even is around 3%. That would suggest we've already gotten forward break-evens close to zero. The market, as I said, is starting to suggest that the Fed is making a policy error. And all the excitement around the historical inflation number, you don't get that back, right? I mean, if we have 10% deflation, to get that back, that is a disaster. And that's effectively what that tweet was highlighting. I saw an identical one today where somebody said, there can't, if you think this isn't a bubble in housing, let's hike interest rates to 10% and see how, the housing market responds to it. Well, we know how the housing market would respond to a 10% interest rate. And all that's telling me is I don't want that person in charge of the Fed, because it's basically, let's experiment on people to see if I'm right. Like, that's a terrible policy. Position to take.
They've already, if they want demand destruction, I think that one of them even said that last week. I don't pay specific attention to their predictions because they're useless. But, the audacity of some of these comments, the pain that's already been felt in terms of, even if you look at MBA purchase applications week over week are trending, they're going straight down. This is not, there's a direct relationship, as you know, between affordability and the cost of capital when it comes to housing. So on that, or go ahead.
Yeah,
go ahead.
No, I was just going to say, and we're seeing, by the way, the same thing. We're hearing of unprecedented slowdowns in the transport area as well, right? We're seeing an extraordinary reduction in the new orders index. And it's fascinating if you listen to the National Association of Purchasing Managers and their discussion around it. They're dismissing the new orders dynamic, right? They're saying, oh, well, it's different this time. We're not actually seeing the slowdown. Doesn't mean it's actually a slowdown. It's just a return to normalcy. Yeah, well, it's a little bit like adjusting the temperature in your car when you get in on a hot day. Do you set it to the temperature you want, or do you set it to 5 degrees cooler because you have some imagination that you're going to get it there faster if you put it on max AC as compared to a more normal temperature? No, it just means you're going to have to adjust it back in the other direction once you get too cold. And so it feels like we're engaged in what I can only describe as like punitive policy decisions at this point.
Guys, if you show slide 35, just so people have, what I like is when a pro's making good points and we could just show the data that backstops it, as opposed to the narratives you hear in this day and age that are largely politically biased to start. But on the right side, Mike, we were just showing that what happens when 30-year fixed rate gets anywhere near 5. That's a very obvious and long-standing relationship. So it wouldn't just have to be surmising that it's different this time, which is some of the most dangerous words that can come out of one's mouth, but having a plan that is attempting to address your prior mistakes, which is having no visibility or nowcast, in our case, that this was ever going to happen to begin with in terms of inflation. So I think we agree on that. Back to the flows. Is there a case to be made? Because you'll take literally the only signal that I have in our model across all global macro markets at this point is interest rates. At this point, as you enter quad 4 disinflation, you would have falling interest rates because the Fed, if only, would say, okay, enough's enough, I even get it. Is there a flow argument to be made on, like you mentioned it right at the beginning, from a pension fund allocations perspective, where for the exit of Treasury bonds, early in the year, because everybody who's a pension fund allocator has to get out of it because they have to fight inflation?
Well, I think rates are interesting, right? Because we knew that the Fed was going to not be purchasing, but there's some very technical things that are happening in the rate market that you have to be deeply involved in the derivative space to fully understand. Effectively, and I wrote about a similar framework in the equity markets just about 2 years ago at the start of the coronavirus pandemic. What I referred to, I wrote a paper for Logica called Policy in a World of Pandemic, Social Media, and Passive Investing. When the Fed is looking to the market signals, they are in turn influencing the market with their commentary on those signals, right? So what we saw in March of 2020 that I was highlighting is the steep correction in equity markets was going to engender a policy response, which in turn meant that the markets were likely to rip significantly higher because nothing was fundamentally changing in the core thesis, right? So the Fed was stepping into an adverse event that would cause prices to go much higher. In the rates market, something similar is happening right now, where the Fed is exactly as you articulated, they declared inflation transitory last year. That has proven to be a problematic description for political reasons. One, it appeared insensitive, and two, it appeared nonsensical as inflation continued to move higher. And by the way, I'm guilty of this as well. I continue to think that the inflation is transitory. You're mentioning going into quad 4, where you enter into disinflationary or deflationary conditions. I see it very, very similarly, right? But it takes a while. And the second component is I think that there's been some bad will around it, where transitory clearly refers to the inflation rate, not the level of prices, right? So an increase in the level of prices is something very, very different than an increasing and sustainable high inflation rate. But regardless, the Fed has now backed themselves into a corner where they need to respond to the idea that they got the transitory inflation wrong. And they're trying to convince everyone that they are serious about hiking rates in a Volcker-esque manner in order to stop the inflationary conditions. And the only thing they can do to do so is by slowing the economy such that demand is negatively influenced. That's not a great policy choice, right? It'd be much better if we could stimulate production of oil or gas, or solve the Russia-Ukraine problem, stimulate production of fertilizer, get stuff in the ground, do all the sorts of things that we know that we're supposed to do to tame inflationary conditions. The Fed cannot go out and plant corn or wheat, but what they can do is they can start to kill demand through the interest rate channel. They're definitely trying to do that. And the problem, of course, is that has then kicked off a cycle in the rates market that is showing up as these extreme moves in the yield curve. And what I would highlight there, my partner, Harley Bassman, wrote a fantastic quick note on this, is that, as is often the case today, much of the information we're receiving right now is not a fundamental signal, but is actually a screwed up signal that is going into the market because of hedging activity. There's a very specific structured product that's out there where you could receive a premium yield associated with the spread between 10s and 2s or other parts of the yield curve. This is a structured note that went out. And if you just think about what it would do, it would lever that spread, right? So you'd basically get 5 times that spread. You can't charge people when that spread goes negative. So the actual outcome is that the street has been short effectively a rate spread floor. And that rate spread floor needs to be hedged. And that's a big chunk of what you're seeing in the rates market right now. This is part of the reason why the front end of the curve is indicating that the Fed is way behind and is going to have to hike many more times than they've articulated. You know, that 9 times that you're highlighting, if I go out 1 year, the 3-month is somewhere in the 3+% range. And the market is basically saying multiple 50 hikes. The Fed is going to have to, dash to do this. But that's not actually what the market is saying. The market instead is saying, holy cow, I'm not going to use profanity. Holy cow, I have to hedge my exposure because I'm now naked short this floor. They're getting tapped on the shoulder. They're rushing out and buying effectively puts on the rate floors, which has the impact of when you're hedging that, you have to delta hedge that exposure. It drives even more demand for the yield curve to go negative. So the Fed is receiving a bad signal. They don't understand this is my takeaway. And for that matter, it doesn't really matter because they're now forced into a narrative of, no, we're taking this seriously, even as we ignored it last year. Last year, they were wrong to ignore it. This year, I would argue they're wrong to chase it.
Yeah, that signal on slide 49, we're just, for those of you that aren't aware, I mean, it's one of the first things I look at when I get up in the morning is, and we color it up, but I mean, obviously most pros are looking at this. This is what the quote unquote Fed is expecting to do because they think the market's telling them to do that. And that's, you struggle with that a lot. I mean, what's really interesting about that, the answer that you just gave, or you articulate an explanation that fits a lot with how you think about gamma in the equity market and options expiration, but you're essentially talking about the floor or the elimination of the floor in the bond market. This is these flows. They really find ways to change things faster and faster and faster. What about the speed about that? Like, what about the speed of that in this day and age? Is it just endemic to the machine's nature?
Yeah, I think unfortunately it's endemic to the machine's nature where you've removed buffer stocks, right? So if you think about it in inventory terms, prices are going to react much faster if you have less buffer stock. The Fed, because of Volcker's, the Volcker rule in 2008, et cetera, has effectively regulated the market into having very limited buffer stocks of securities. The prop desk inventory of bonds has collapsed. The depth of inventory in terms of the bid ask within the S&P 500, what's called front of book liquidity, has deteriorated sharply. We're seeing this in individual stocks where more and more of the demand is being captured by option hedging activity. Just basically everything is telling you that the market is inelastic and fragile. So everything happens faster, right? It just is there's a quicker response function when you have less buffer inventory.
Yeah, and that's why the reverse can happen faster. I mean,
yes.
To me, that chart, I mean, if you substitute a chart of 2-year yields, which is what's driving the inversion of the yield curve, all I have to hear him say is we're not doing that. You know, like we'd be lucky. Let's see if we get through. And I want to hear your thoughts on this. I get told by many, I mean, I shouldn't say the majority, but many institutional clients of ours will say, I hear you, but the Fed is on a path to be like Paul Volcker. They're going to do this. The market's got it right, and they're just listening to the market. And they tell me I'm bananas, basically, without saying it impolitely. I would never be impolite to anybody, certainly if they're paying us. But they would say, I say, look, you tell me if they do 50 basis points in May, I think that could be it. You know, if we keep getting these market conditions that aren't at the same kind of surface area of the S&P 500, more in the ABS market, what's happening in high yield, what's happening in junk, what's happening globally, by the way, what's happening to the oil price today, then I think that the step function of that chart that I just showed on slide 49 could be material. Like you go from 9 hikes to 5. I mean,
I completely agree with that. That's what I'm watching very, very carefully.
You completely agree with that?
I completely agree with that.
Because
I mean, not the part about not being rude to people paying you, but I think that's when you want to be rude to people. when they're paying you for advice. But the point that I would make is that we are absolutely in a situation where people think that the market is telling them something. Hopefully, what was clear from the explanation I just offered. This is not a fundamental signal. There's always echoes of fundamental signals in those types of dynamics, but almost inevitably you end up seeing that there is some form of economic activity going on in hedging, et cetera, that is driving this type of market behavior. It's the same thing, by the way, that drove the 10-year to 33 basis points in March of 2020. And then 3 days later, it was back at 120 basis points. You know, that was a market event. It was a market liquidity event associated with the liquidation of Ronin Capital. If you're not in the market on a day-to-day basis, if you're not dedicated to trying to understand this sort of stuff, you're going to get the, proselytizing on CNBC or elsewhere where they say, well, the market was up because of X, right? And it's inevitably an explanation of what's happened in the past. This is a market structure dynamic that's driving it, and the market must respond if the Fed says they're going to hike. Just imagine how an option market or a decision tree works. You start at point 1 and then it either goes up or down. Again, then each of those nodes either go up or down. When the Fed is telling you flat out they're going to lift that front node, every part of that surface has to be lifted, right? And so the market responds to the Fed. The Fed then thinks the market is saying, okay, the Fed has this correct, even as the yield curve is doing exactly what you're seeing, which is this massive inversion. And the New York Fed actually came out with what I consider a laughable paper in the last week. It's called Don't Fear the Yield Curve, Reprise. 2 researchers at the New York Fed wrote a paper in 2018 saying you don't need to worry about the yield curve inversion. And they're now out with another paper saying, well, yes, there was a recession following that yield curve inversion, but that was because of COVID, so it didn't really matter. And this one doesn't matter either. And oh, by the way, the only thing that matters is you should be following the very front of the curve, what they call the near-term forwards. But that part of the yield curve only responds to Fed intention. So effectively what the Fed is telling you, don't fear a recession because the Fed doesn't see a recession. That does not feel like a helpful message to me.
Yeah, don't fear inflation last year at this time because it's transitory. Don't fear a recession because it's ridiculous. Okay, so we have signaling on yield curve. Let's go to signaling on corporate spreads, okay? You know, whether it be high yield OIS spread, which is an explicit quad 4 signal for me right now, or corporates. I think we have corporates on slide 45. You know, you could see go back to 2018 on this is a chart Mike's well aware of, but just so everyone knows what we're talking about. If you go back to that, see that dotted line? See where the angst line, as we call it, went to right in 2018. The minute it got there, Powell got the phone call from our former partners at Carlyle and beyond. I say this to every institutional client. I say, you tell me what he's going to do when that's happening to private equity or that's happening to the credit market broadly.
Well, I agree with you, and while I'm not sure that I would say that I would associate the same dynamics of the call from Carlyle, although obviously they have a connection there, and the Fed will absolutely pay attention to the input from sophisticated market participants like Carlyle. The simple reality is that the Fed is indicating that they're not going to respond to this signal, right? They're not going to respond to the credit spread dynamic. I personally think it's a mistake. I think that they will be forced to do more going forward. But they are very explicitly saying it's not that big of a deal right now. And I do think this is part of the irony of having gone through the extreme nature of the coronavirus. I think it's super easy for people to be very sanguine about the current environment that we're in. Hey, if we solved that and we didn't get a credit cycle associated with that, like just imagine ordinary, regular slowdowns. This is not a problem. The Fed totally has this. And we're going into a divided Congress. We're going into a divided Senate. We seem to have ineffective leadership for the umpteenth time. It is hard to imagine, in the absence of a significant market event, that the Fed is going to be anywhere near as aggressive, or that Congress is going to be anywhere near as aggressive in addressing a potential recessionary condition as they were last time around. It just feels like there's much less certainty than was created by a 3-week, nearly 30% drawdown type environment. Mm-hmm. So it's going to take a lot to push the Fed off of that.
Yeah, I actually say that in response to institutional clients as well. I say, unfortunately, if I'm right on this, I'm going to be more right on this, because the Fed tightening into this, again, the Fed's looking backwards at, even most recently, the sequential GDP acceleration to 7% is going to go to zero. I mean, you go from 7%, they think it's 7%, their financial projections for GDP are based on the backwards looking, slide 52, they'd look at this on earnings, Mike, and they'd say, well, that's bullish, but they got it backwards like they usually do. I mean, you look at earnings growth in the fourth quarter, 30%, what could possibly go wrong? GDP is 7, earnings are 30, and again, earnings could easily slow towards 0% by the second quarter against these comparisons. So again, there's a pretty strong correlation. And tell me if you agree or disagree. We've agreed on too many things, by the way. But it's like, if cash flow growth goes from 30% growth, or where it was at this time last year, 87%, as you can see on S&P 500 earnings in the second quarter, towards zero, like, what does corporate credit do on that?
Well, I mean, part of the dynamic there. Yeah, I mean, but with nothing else going on, the answer is, of course, it depends, right? But what we are seeing very clearly in the corporate credit market, and my good friend Alex Gurevich just talked a lot about this, et cetera, the same influences we're seeing in the mortgage market, where rates have gone from 2 3/4 to 5, and we're seeing an absolute plummet in purchasing intentions. We're seeing the potential for inventory to rise significantly because it builds on the market as compared to being immediately snapped up by people who are well qualified to purchase homes, right? When you raise interest rates, you're lowering the percentage of people who qualify to purchase a new home, or a first-time home in particular. When you think about that type of dynamic, it just takes a long time, right? There's long and variable lags, but we're already seeing within the high yield space here in the United States, and particularly in Europe, you're not getting refinancings done. You're not getting that next cycle done in terms of being able to afford it. Companies are holding off, basically playing a game of Russian roulette, saying, well, we can't tap the capital markets, because if we were to tap them at these higher yields today, that would effectively guarantee insolvency or a significant deterioration in profits. They're holding off in the hopes that rates will retreat and they'll be able to refinance at a higher level, at a lower level, But that is effectively raising default risk significantly. And you're starting to see that in that line that you highlighted where the credit spreads are beginning to widen. What's different this time is because credit spreads had gotten so tight and because yields had gotten so low, the duration that was embedded in things like high yield, the sensitivity to long-term interest rates that had gotten embedded in high yield was so high that explains roughly 2/3 of what we've seen in the selling off of high yield so far on a year-to-date basis. This is one of these rare instances where investment grade credit is behaving almost as badly as high yield credit,
right?
Because we just don't have a credit cycle priced in yet. What we've seen is a sell-off in duration, but that's weakened portfolios significantly.
Yeah, that's what I mean by that. Like I'm usually, our nowcast is usually looking at least 1 to 2 quarters ahead. God forbid I go out a full year. But it's a better way to do it. The Q2 of 2022 is the nastiest comparison in the history of America. And so that's why I was showing that prior slide, because we have the toughest revenue compares, the toughest margin compares, the toughest cash flow compares. It's all the same thing. So again, that's when the credit cycle becomes more readily apparent, as corporates have to announce that. And that's why it's going to be more interesting as we go throughout the year, is that one by one, we're still only in the first quarter. We're about to get through the first, and maybe that's what the markets, equity market finally cares about today, earnings season. The banks have to talk about an inverted yield curve. It's one thing for the Fed to say the inverted yield curve doesn't matter. It's another thing to, for somebody who has to eat net interest margin for lunch is going to say that it's not going to matter. Do you think that you'll hear that from a bank?
Oh, I think they're going to be forced to address it. Among other things, right, I'd highlighted this dynamic of the spreads being explicitly incorporated into things like structured products and creating losses for banks regardless of the underlying lending conditions, right? I mean, the product that I described is effectively a perversion of a traditional bank spread product where you've embedded the leverage inside the product instead of in the bank, as you did in 2007. The banks ultimately, that is off balance sheet financing in one form or another. It can come back and bite them in a pretty big way. So I do think that we're going to see a lot of those discussions. I think we're also seeing companies like Apple particularly vulnerable in the what I would describe as the new consumer durable space, where your iPhone is expected to last 3 to 4 years. The price of iPhones is under pressure. The need to replace the iPhone that was replaced in early 2021 or early 2020, the resistance to replacing that with the next model, I think, is very clearly growing at the same time that we're seeing pressure on inventory. And that's the last thing that I would hit on with the profit cycle is, when you think about Q1 2021, you were beginning to experience pricing power because of the excess of demand. We were seeing year over year inflation kick up without necessarily costs having kicked up. If I think about how inflation, particularly in goods, shows up, it shows up as extremely high profit margins initially because you're selling cheaper inventory into a market where you have pricing power. The issue is you actually don't know what your profit margins were, because when you replace that inventory, it becomes much more expensive. And therefore, you're looking at a forward situation where you might have actually created much lower margins going forward. And I think this is one of the real uncertainties as we look into the earnings cycle in 2022 and even into 2023. How much and how inexpensive will it be for businesses to replace inventory? Everything ranging from used car inventories, which we're beginning to see deteriorate rapidly, which would suggest that car dealerships have overpaid and are looking at potential risk in their earnings reports. Leased vehicles, the resale values could be significantly lower. These are all things that play long-term into profit margins. And we don't have any clarity on what it looks like right now.
Yeah, you think these guys selling used cars had a good year last year? I mean, this is like some of the most ridiculous charts that we have in this macro deck have to do with just that. I'm trying to find, guys, if you could show the Manheim chart as I'm just kind of flying through here, just so that people have a reference point from in terms of what Mike just said. If I tie this back, and I want to get into equity options here next, but I just want to tie this down one more time on. Any thoughts on what's happening in from an ABS market perspective, liquidity, et cetera?
Well, I think broadly we're seeing poor liquidity in the ABS market, period, right?
Yep.
And so when you start talking about auto leases or auto loans, those tend to be the almost they tend to be the explicit backers in things like asset-backed securities, right? Which is what ABS stands for. So you're taking a whole bunch of those types of loans, bundling them together and selling them off in various tranches. The credit quality has been reasonably written given incomes. What always falls apart is if those incomes deteriorate. And when the Fed is targeting demand destruction, in the simplest form, that can be said as they're targeting your job, right? That's the way they get you to reduce your demand, is not by soaking up your cash, by paying you higher interest. They get it by soaking up your demand, by forcing you out of your job. The thing that I think the rates markets are largely pricing in is a very real risk that we're repeating the exact same mistakes that were made under the Bank of Japan in the 1990s, which is cutting off an expansion before it's fully formed. And that's what the market appears to be signaling, is that we are going to return to that low demand environment. And all I can tell you is, if you're in the market for a camper vehicle or an RV, expect the used the used sales of those types of products to be off the charts in the next couple of years.
There's that Manheim Index. It's like one of the bubble. There are plenty of bubble charts that were coming out. There are plenty of asset price bubbles. We don't have to get into like earning our PhD in forward-looking, inflation and whether or not it is or it's good or bad for humans. I mean, this is the only time this has ever happened in human history. So what could possibly go wrong?
So just to highlight this chart, right? I mean, that chart, I just want to be clear, can actually be explained with very little input from the Fed, right? So what actually happens in the United States, we have somewhere in the neighborhood of 300 million autos. The average life expectancy of those autos, the average life is somewhere around 12 years, which means that in any given year, you need to replace somewhere around 15 million vehicles in a normal course of business just to maintain the fleet. That's a real problem, because for the past 2 years, we've produced somewhere in the neighborhood of 12 million vehicles. So we've been running a significant shortage. If you actually calculate how much the prices of used cars had to rise in order to replace those lack of new cars, it's almost perfectly matched what we've experienced, right? And so now the fact that we're actually slowing this down and creating conditions while we're still only producing 12 to 13 million vehicles, under which we can begin to see used vehicles decline, that tells you how weak the economy actually is.
Yeah, I mean, it's for a lot of people. I mean, the 50% of people that have less than $500 to their name in America, their number one piece of collateral was that used car, and a lot of them sold them. So you have a lot of things going on. I have to get to the queue here. Some questions which you're going to get a lot of questions on. You should. I'm going to put a kind of ring fence around a bunch of them on equity options and what's going into these super short term, 1 to 3 days out YOLO options buying. Can you give? I mean, the March quarterly OPEX or options expiration was eye-popping, suffice to say.
Yeah, well, I think that there's a couple of different things that are happening there. One is that there's an increasing trend towards institutional strategies that are either buying or selling options and holding them through maturity because it's a systematic strategy, right? So the modeling has been written in a certain way in order to maintain the viability of an index from which you are managing. You have to have the same approach and you can't deviate from it. And so a portion of that is just longer dated options that are then rolling forward, and some of these eye-popping maturities that you see can be associated with that. The second issue is that because volatility, the implied volatility, has risen so much, particularly at the longer end relative to its history. So if I go back to 2017, for example, which is kind of the extreme, the longer dated volatility measures were hovering somewhere in the 17% range. Those numbers are now, give or take, 50% higher, pricing 27, 28 as a fairly typical level for a 1 year or a 2 year put option or variance contract. So the back end being so elevated has made holding options positions much more challenging and much more expensive. And that's created a dynamic in which people are increasingly pulling forward and, as you point out, YOLOing into effectively one-off bets. You can just liken it to when somebody gets low on their bankroll at a craps table in Las Vegas. They start playing silly because they know the game is going to end anyway. So you might as well swing for the fences, right? Putting it on cable cars or on a hard 8 as compared to on the come line. Those sorts of dynamics are clearly playing through. And I would just suggest that we're seeing more and more evidence of end of cycle kind of speculative activity. And that's true across indices and also in the single name equities as well. I mean, just very recently, we saw a tremendous amount of call selling and call overwriting in Apple that created conditions under which you could pick up optionality to the downside in Apple quite cheaply. We were fortunate to do that in a few of our products.
Yeah, I mean, it goes both ways. This options,
right.
Certainly Gamma does, and it's to me, it's just an amazing thing to watch. Where do you think? And this question, we're going to take at least one question on crypto, but where do you think people get hurt the most? Or does it have to be the most? YOLO equity options or crypto?
Well, I mean, can I say both, right? I mean,
exactly. Is there a way to differentiate them? I mean, your money's going away faster.
Yeah, I mean, look, to me, crypto, and people have heard me talk about this. I have a very particular concern around Bitcoin. I think that the way it is being marketed, the idea that it is the safe reserve asset for the future, basically feels the equivalent to me of arguing that MySpace is, staking out the geography for the next generation, right? I don't see it that way, but I do think that there's something very important that's going on in both the development of the infrastructure and the capabilities around digitally native securities. And those who have watched my podcasts or interviews will see that I often hold up a 1 penny dividend check that I received because my child has a framed stock certificate, I believe, to Southwest Airlines on their wall, right? It was a gift that was given to them, but now I am unfortunately the physical owner of a share, which requires me to receive 1 penny dividend checks. That's completely insane. The cost of sending out that dividend check is a multiple of what I'm actually receiving. The cost of putting it through the banking system, completely absurd. Digitally native securities start to address that. They start to create all sorts of interesting things to do, but we don't have them yet, right? We don't have anything worth buying in that space. And so we have to pump through a whole bunch of speculative garbage to attract attention to justify the building of the infrastructure, not dissimilar to what happened in the dot-com cycle. And I would highlight, we saw in the dot-com cycle an explosion of IPOs. I believe the data is that Coinbase has listed 2,700 tokens in the last year. Wow. I mean, that makes the IPO boom of 1999, 2000 look completely, like it's a piker.
Oh my! There's a question from Frank's a good one on this. When you use the analogy driving uphill with no brakes regarding passive equity markets, how would you say that analogy, Mike, translates to Bitcoin, where it seems the intention for many participants is to hold the coins and never sell them?
The only point I would make is that for those participants, you have bought into a religion, the idea that you hold anything and never evaluate selling it because it represents the future, works in a religious context potentially, but it doesn't work in an investing context. So, I mean, there is no fundamental analysis going on once you've decided to buy in and hodl. And unfortunately, that is exactly the message that they are trying to get you to have, right? I have posted any number of marketing pitches coming out of the crypto space, particularly in Bitcoin, where it is very explicitly stated, the only news that can be put out about Bitcoin is good news. The only news that can be highlighted is number go up, right? We don't talk about bad stuff. We don't acknowledge bad stuff. We attack it, et cetera, right? Like that sort of behavior bears far more in common with a cult than it does with an investment philosophy. It does me no good to attack somebody for, shorting Coca-Cola. Actually, they're creating future buying of it, right? So I should applaud the efforts that they're putting out there. This weird religious fervor, it only makes sense in the context of this being effectively a giant scam.
I guess that's why you've triggered some people here. These are the popular questions that are voted up and are in the queue.
Yeah.
So this one more question on that topic from Chris. Mike's been a notable critic of crypto, Bitcoin, et cetera. But is there anything that you like longer term platforms such as Ethereum or Solana? Anything?
So the quick answer is I think we're too early to declare platforms that make sense. There are activities underway, and I know that this feeds into the narrative that I'm a statist and the only thing I care about is the government. But the reality is that regulation is coming into this space. There have been a couple of developments. The eCash proposal that is currently on the House floor is a brilliant proposal. I encourage everyone to reach out to their congressperson and support it. It'll come under attack from the Bitcoin bros, et cetera. But the reality is we have a proposal in front of us that creates CBDC-like characteristics with privacy protection. This is a phenomenal development, and we should grab it while we can. The platforms like Ethereum and Solana, Peter Thiel has correctly pointed out that these are effectively payment rails. Whether they are adopted or not is very, very difficult to know, but at least they represent what I would describe as utility tokens that have the potential to appreciate or have the potential to earn a yield associated with facilitating economic activity. Those are much more interesting to me than the proof of work type coins like a Bitcoin that's trying to replace something that it's clear its proponents don't fully understand, gold, right? And so when we look at that sort of stuff, I think it's very interesting to focus on what is being done at the state level and to begin preparing yourself for what comes after that. But this is where crypto overlaps with a lot of the other stuff I do in passive, for example. As a mechanism, NFTs will ultimately become very important in creating digital scarcity and allowing me to say, this is my stock certificate, not your stock certificate, which is slightly different. And I can do different things with mine than you do with yours. Those are huge advances that are coming. But right now, the entire space is desperate for product, as evidenced by 2,700, token IPOs effectively on Coinbase in the last year. And so anything that can be pumped through, I just think you have to, cast a skeptical eye and focus yourself on building and understanding what's happening in the space and positioning yourself to take advantage when there's greater clarity around it. But it feels to me like crypto winter is approaching, not that it's not in the rearview mirror.
Well, a lot of people really don't like the back test on that, which is when you're in quad 4, crypto gets crushed. I mean, it's just because it's what it is.
It's a speculative asset. It's a speculative asset.
Yeah,
Let's call it what it is, right?
Yeah, it's. And when people think about the factor exposures that don't work in quad 4, they are growth, storytelling, fully embedded therein, high beta. Everything that they have no asset class has had more realized volatility in the history of, and I don't even call this a long-standing asset class because it hasn't been, than crypto.
Yeah.
So that's
unfortunately, the narrative has been built right on the HODL framework. If you can't survive an 85% drawdown, then you shouldn't be playing in the game. And oh, by the way, everybody should be playing this game because it's the future and it's the only path to success, right? So if everybody is positioned for an 85% drawdown and it's convinced themselves that they're going to hold through an 85% drawdown, well, the only difference between an 85 and a 90% drawdown is, a further massive decline, right? So people are just going to sit there and play this out. We saw the same behavior with the dot-com cycle, right? I mean, if I've mentally prepared myself that an 85% drawdown tells me nothing about the asset, where do I sell? Yeah. The answer is you don't, right? You hold it into the dust. And that's the other thing I would just highlight about the Bitcoin network and most of these networks is unless there is a mechanism for transaction fees and real value being created around that, not just a store of wealth. A store of wealth by definition can't be cash flow negative at all points into the future. You can't have to continually pay into a network to have people validate it. They've heard me talk about this. I am not a proponent of gold, but what I will say about gold is if I buy it and I stick it in a shoebox and my grandchildren, pull it out of that box, they will say, oh, look, it's gold because it's an element on the periodic table. It's not going to corrode away or oxidize away in the way that other stores of mineral wealth or metallic wealth may, right? Copper, for example. But it doesn't require a network to be maintained for the next 100 years for my kids not to open it up and be like, ooh, look, it's an old flash drive that doesn't fit any of the technology. That's just not a realistic store of value, right? It's just not. Right. I mean, how many flash drives do we retain from the Roman Empire?
Oh man, you're so. I mean, pardon the pun, but simplifying the complex. It's just like It is what it is, and I think what people probably appreciate if they haven't heard you speak yet is the breadth and how you can get it back down to like the things that actually fundamentally matter to you the most within your framework. So that was awesome, man. Unfortunately, we don't have any more time to ask any more questions or see how many more people you've triggered on crypto or the 2,700 coins that have been created. But thanks for your time. We appreciate it.
Thank you very much, Keith.
He's Mike Green. Up next, after I have a little bit of a sandwich, Mike. No, we don't have Mike. We have Kyle Bass.